Here's a thought experiment. Imagine every pension fund, sovereign wealth fund, and university endowment in the United States pooled their assets together. Teachers' retirement funds, oil-funded national savings, Ivy League endowments. That pool would be roughly $26 trillion. Now imagine one company that holds about twice that amount in custody for institutional clients around the world. That company is State Street Corporation. I'm Hudson Thomas.
And I'm Lana Chen. Today we're breaking down State Street Corporation, ticker STT, a Boston-based custody bank and asset manager that just reported record first quarter 2026 results on April 17th, 2026.
The headline numbers: $54.5 trillion in assets under custody and administration, a new record, up nearly 17% year over year. $5.6 trillion in assets under management, also a record. Total revenue $3.8 billion, up 16% year over year. And management raised their full-year guidance on both fee revenue and net interest income. Lana, your quick read?
My quick read is that State Street runs the plumbing of institutional finance, and right now those pipes are running at record volume. When you hold $54 trillion in custody and a volatile tariff-driven quarter turns into a 29% surge in FX trading revenue, you start to see why this business model is so durable.
State Street Corporation was founded in 1792, before the United States had held a single presidential election. Today it operates from Boston across more than 100 markets in 26 countries. The core business runs two lines: investment servicing, the custody and administration operation, and investment management through State Street Global Advisors, one of the world's largest asset managers.
The distinction matters. Investment servicing is pure B2B. State Street holds and accounts for assets on behalf of pension funds, sovereign wealth funds, insurance companies, and ETF providers. They don't own those assets. They safekeep them, account for them, facilitate trading and settlements. Investment management is where they actually run money, primarily through index ETFs under the SPDR brand.
And if you've ever bought an SPY ETF, the S&P 500 tracker that's been around since 1993, you've been an indirect State Street customer. SPY was the world's first U.S.-listed ETF. State Street invented the category. In Q1 2026, their SPLG fund, the lower-cost S&P 500 alternative, became the #1 asset-gathering ETF globally, with $27 billion of net inflows in a single quarter.
The moat here is formidable. When an institutional client puts $50 billion of pension assets into State Street's custody, switching costs become nearly prohibitive, repapering hundreds of legal agreements, migrating decades of transaction history, retraining operational teams. Client retention in custody banking runs above 95%. Once you're in, you stay in.
And the why now catalyst is counterintuitive. Market volatility, which hurt most companies in Q1, actually helped State Street. Tariff-driven uncertainty drove record institutional repositioning flows, and State Street's FX trading desk captured that with a 29% revenue surge. Meanwhile, SSGA's ETFs attracted record inflows as investors repositioned portfolios.
Their Charles River investment management platform, acquired for $2.6 billion in 2018, is now deeply integrated into client workflows for front-to-back investment operations. That creates a second layer of switching costs beyond custody itself. Institutional stickiness on two fronts.
Running this operation is Ronald Philip O'Hanley, President and CEO since January 2019. Before State Street, he spent years at McKinsey as a senior partner advising financial institutions, then ran Fidelity's asset management division. He joined State Street in 2015 to modernize the asset management business before taking the top job 4 years later.
O'Hanley's reputation on the street is that of a strategy-first CEO who operates in decade-long frameworks. His most visible achievement is 9 consecutive quarters of positive operating leverage, revenue consistently growing faster than expenses. That kind of sustained discipline doesn't happen by accident. It requires explicit cost targets, technology investment prioritization, and the willingness to take painful charges, like the $130 million middle office restructuring in Q1 to set up a better long-term cost structure.
His Q1 decision to raise full-year guidance immediately after a GAAP EPS miss is a signal worth noting. CEOs don't raise guidance when they're uncertain about the trajectory. He's essentially saying the restructuring charge is behind them and the underlying business is accelerating. The analyst community, with 12 buy-equivalent ratings, appears to believe him.
Let's get into the financials. State Street has a market cap of roughly $40.5 billion. At $145.43 per share, it trades at 14.8 times trailing earnings and 1.46 times book value. Forward PE is around 12.5 times, reflecting analyst expectations for continued earnings growth.
One thing to frame up front, State Street's net interest margin is 116 basis points. That's 1.16%. For comparison, most regional commercial banks run 3 to 3.5% NIM. Custody banks operate differently. They hold massive institutional deposits that earn very thin spreads. The business compensates with high-margin fee revenue that's more stable and less rate-sensitive than loan interest income.
On revenue, Q1 2026 net revenue came in at $3,795 million, a record quarter, up 16% year-over-year. Net interest income contributed $835 million, up 17% year-over-year. Fee revenue, servicing fees, management fees, FX trading, and securities finance contributed the remaining approximately $2,960 million.
The earnings picture is more nuanced. GAAP earnings per share came in at $2.31, which missed the $2.64 consensus by 33 cents. That miss is almost entirely explained by a $130 million pre-tax charge for rescoping a middle-office client contract. On an adjusted basis, EPS was $2.66, beating the $2.62 adjusted estimate.
The market looked right through the GAAP miss. The stock was up 4.5% on earnings day. Return on tangible common equity on an adjusted basis came in at approximately 20%. For a custody bank, 20% adjusted ROTEs is exceptional. Most custody peers run in the mid to high teens. That's 9 consecutive quarters of operating leverage showing up in the return metrics.
On the balance sheet, $392 billion in total assets, common equity of $27.7 billion. Capital remains solid with a common equity Tier 1 ratio of 10.6%, and State Street is returning capital aggressively. $400 million in buybacks in Q1 alone, plus $233 million in dividends paid.
Cash generation for fiscal 2025 was $3.3 billion in operating cash flow and $2.7 billion in free cash flow. I'll flag that the quarterly figures swing dramatically from positive $2.4 billion in Q1 to negative $8.4 billion in Q2 and back to positive $7.9 billion in Q3. That's normal for custody banks. Client settlement flows create massive working capital swings quarter to quarter. The annual figure is the meaningful number. Overall, State Street's financial health is strong. Record assets, raised guidance, 20% adjusted ROTC, and 9 consecutive quarters of positive operating leverage tell the story.
Wall Street is broadly constructive on State Street after Q1 results. The consensus is buy, with roughly 18 analysts covering the name, 12 with buy or outperform ratings, 5 hold, and 1 sell. The average price target is around $165, implying about 13 to 14% upside from current levels.
Morgan Stanley maintained their overweight, citing State Street as one of the largest beneficiaries of rising global asset prices and elevated FX market volumes. KBW kept their outperform, specifically highlighting the 20% adjusted ROTCE as running ahead of custody bank peers and calling the $400 million in Q1 buybacks a demonstration of capital confidence. And the most notable action, Bank of America upgraded State Street from underperform to neutral.
That Buffet upgrade deserves context. The prior bearish thesis was that State Street would disappoint on GAAP EPS, and they were right. It did miss on GAAP in Q1, but the stock still went up 4.5%. When a bear thesis plays out perfectly and the stock rallies anyway, upgrading to neutral is the only logical response. The GAAP miss was absorbed. The raised guidance was not.
Post-earnings analyst commentary was notably constructive. Evercore ISI kept their outperform with a 182 target, highest on the street, citing AUCA growth trajectory and SSGA inflow momentum. Even the more skeptical equal weight and hold names moved their targets higher after the guidance raise.
Let me make the bull case. State Street just posted record assets under custody of $54.5 trillion, up nearly 17% year over year. Record AUM of $5.6 trillion, up 20%. These aren't abstract numbers. Every trillion in new AUCA generates roughly $20 to $30 million in incremental annual fee revenue. The asset-gathering machine is running at its fastest pace in company history. And the SPLG story is remarkable. Their low-cost S&P 500 ETF gathered $27 billion in net new assets in one quarter to become the top global ETF by inflows. That's not a legacy franchise coasting. That's a franchise actively winning market share. Add 9 consecutive quarters of positive operating leverage and management raising guidance on both revenue lines, and the bull thesis is compounding.
Here's the bear case. The GAAP EPS missed by 33 cents, and while a restructuring charge explains it, the pattern of one-time charges at custody banks is worth watching. More structurally, the 29% FX revenue surge is cyclical. In calmer markets, institutional repositioning volumes normalize, and this outsized tailwind reverses. You cannot budget for tariff-driven volatility as a permanent tailwind. And passive fee compression is the slow-moving freight train. SSGA's average fee rate on their ETF lineup trends lower every year as investors migrate to cheaper products. AUM growing 20% solved that math in Q1, but that growth rate depends on equity market appreciation that isn't guaranteed. If the Fed cuts rates twice in 2026, NIM at 116 basis points gets meaningfully compressed. And if global equity markets correct 10%, AUA and AUM both decline, hitting fee revenue on two fronts simultaneously.
How does State Street stack up against the custody banking universe? We're using price to book. It's the right valuation lens for this sector.
State Street sits at 1.46 times book value. Compare that to Bank of New York Mellon, ticker BK, at 1.99 times book. Northern Trust, NTRS, at about 1.5 times book, and Charles Schwab, SCHW, at roughly 2.7 times book. State Street is trading at a discount to all three. On NEM, BK runs around 135 basis points, Northern Trust around 155, and Schwab closer to 200 basis points. Schwab benefits from wider spreads on brokerage cash sweep programs.
The discount to BK is the most interesting data point. State Street and Bank of New York Mellon operate nearly identical custody plus asset management business models. BK's higher multiple isn't obviously justified by better fundamentals. If State Street can sustain 20% adjusted ROTC while BK runs in the 17 to 18% range, the valuation gap should narrow. That's the re-rating thesis in one sentence.
Northern Trust's slightly higher NIM reflects its ultra-high net worth wealth management client base, which generates wider deposit spreads than pure institutional custody. That's a business mix difference, not an operational advantage for the pure custody comparison.
Quick look at the options market. State Street carries a beta of 1.38, making it notably more volatile than the broad market. It does attract some institutional options interest, given that elevated beta. Post-earnings, implied volatility has settled in around the 30th to 35th percentile of its trailing one-year range.
The put-call ratio is approximately 0.75, a mild bullish tilt. No dramatic open interest clusters or unusually large directional bets from institutional options players that stand out. For investors considering overlays, the moderate IV environment in the wake of the earnings day pop might make covered call strategies worth exploring as an income generator on a core position.
On the insider front, nothing unusual. Routine executive share sales under pre-arranged 10b5-1 trading plans have been the norm in recent months, standard practice for S&P 500 executives managing concentrated position risk. No open market discretionary purchases or sales that would read as a signal.
10b5-1 plans are set in advance and cannot be timed based on inside information, so the interpretation is limited. What is worth noting? No discretionary insider selling ahead of a quarter that set records on AUCA, AUM, and revenue. The absence of opportunistic selling before what turned out to be a strong underlying quarter is at least a neutral to constructive data point.
Key risks to watch at State Street. Number 1. Federal Reserve rate decisions. NIM at 116 basis points leaves very little cushion. Every 25 basis point cut from the Fed compresses deposit spreads meaningfully. If the Fed cuts twice in 2026, the net interest income growth guidance of 8 to 10% faces real pressure.
Second, equity market levels. AUCA and AUM at State Street are directly correlated with global equity prices. A 10% equity market correction would reduce both metrics simultaneously. The fee revenue bull case entirely depends on asset prices holding or appreciating. That's a macro dependency that can't be managed away.
Third, passive fee compression. This is the structural slow burn risk. As ETFs race to zero on fees, SSGA's average management fee rate trends lower every year. In Q1, AUM growth of 20% was fast enough to more than offset the fee rate decline. But that rate of growth requires sustained market appreciation and continued inflows, both of which are uncertain.
And fourth, operational risk. Custody banking is a zero-error business at scale. The $130 million middle office contract rescoping charge in Q1 is a reminder that transforming these systems while running $54 trillion of client assets through them is operationally complex. Watch for processing error provisions or client service incidents in future quarters as a leading indicator of execution risk.
Bottom line on State Street Corporation. This is a company founded in 1792 that now holds $54.5 trillion in custody for the world's institutional investors. It posted record revenue, record AUCA, record AUM in Q1 2026, and raised its full-year guidance on everything that matters, despite a GAAP EPS miss caused by a deliberate restructuring charge. The adjusted business is clearly accelerating.
The metric to watch is AUCA. Every $1 trillion added to the custody book generates roughly $20 to $30 million in incremental annual fee revenue. Right now at $54.5 trillion, the trajectory toward $60 trillion would confirm the bull case. Watch the Q2 2026 AUCA print. If global equity markets hold, it could approach $56 trillion. If markets correct significantly, AUCA moves the other direction quickly, and the fee revenue story gets complicated.
State Street doesn't make headlines. It doesn't sell iPhones or detergent. It holds $54 trillion in trust for the world's most important institutional investors, earns thin but durable margins on every transaction, and right now, it's doing all of that at a record pace. That's the story. We'll leave you with a quote from Albert Einstein that fits State Street's quarter perfectly. In the middle of every difficulty lies opportunity. Tariff uncertainty was a difficulty for most companies in Q1. For State Street, it was a 29% FX revenue surge and $27 billion of new ETF inflows. They run the infrastructure that processes institutional responses to market stress. And in Q1, that stress was very profitable.
Einstein was talking about physics, but institutional finance will take it. When everyone else is stressed about volatility, State Street's trading desks get busier.
That's going to do it for today's episode of Charged Alpha, your guide to the S&P 500, one stock at a time. We covered State Street Corporation, ticker STT, the 234-year-old company that quietly holds more in custody than the combined GDP of every country on Earth. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.